Hi everyone, welcome back to another video, and it feels so good today to see the market in green when BTC and Ethereum both are up 3.5%, BTC trading somewhere around $21,500, Ethereum at $1,200, and this is something which we predicted in the last two videos when we were discussing about the BTC bottom and the market cycles. So if you missed those videos, just make sure to check it out because we have covered some awesomizing analysis. Another very important thing which people ask me a lot is it the end of the bear market and will the market continue to move up? So the answer would be to go and check out the Discord server because we discuss every single thing there. Just an important tip, we have a very strong 4-hour supply at $23,000, so stay very cautious if you're taking the long positions. Another important thing, in this video, we are going to cover everything that has happened on the global scale, everything about the global scenarios, everything that you always wanted to learn about Fed, central banks, inflation, interest rate hikes, and whatnot. So without wasting any time, let's start off with the video. Alright guys, so this is one of the threads that we shared on Twitter 2 days back, and we have tried to cover every single thing that has happened in the last 2 years since the COVID-19 crisis. So global scenario overview which is affecting all financial markets including cryptocurrencies. There are three types of people that are involved. First one is the troubleshooter which is trying to solve the problem, that is Fed. Second one is the culprit which is causing the problem, which is bringing the markets down, is inflation. And third one is the victim, which is obviously the retailers, which always lose money in the market. So let's begin this thread and let's start off with the video. So let's start with the troubleshooter, which is Fed. Fed is the Federal Reserve System, is a central bank of US, which is United States. Now, central bank is a financial institute which is responsible for all the monetary policies of that particular nation, and it has to keep certain checks. First of all, it would need to see the public interest. That means the public is not harmed in any way. Second thing would be employment. Third one would be interest rates. Fourth thing would be consumer trends and spend. Where is the money going from the public? What are they buying? How much are they buying in a particular year? Everything is being tracked by central government and Fed. Moving on to the next person, which is the culprit, inflation. So we know what is inflation. Inflation is the general increase in the price of goods and services. Now, if you have a 100 rupee note and you want to buy a chocolate, you will obviously be able to buy it because the cost of that chocolate is 100 rupees. But next year, if the price of that chocolate goes to 106 rupees because of inflation, you will not be able to buy it with the same 100 rupee note. So this is how the inflation is affecting the money purchasing power of every single individual. It is decreasing with time because the things are getting expensive and you have the same note in your hand. So you will not be able to buy the same thing next year because of inflation. And the third one on my list is the victim, which is retailers. Obviously, I do not need to introduce who retailers are. We all are retailers and the portfolios are blood red right now. Now, one thing that you need to understand is that the Fed will always try to increase the inflation rate, always increase it on the positive side to increase the economic growth. That means every single year, the price of the goods and services will increase by some amount. Sustained decline in the price will be called as deflation, which is opposite to inflation, and it can be even more harmful for the economy. Now, another reason why we have a positive inflation rate or interest rate is that at the time of economic slowdown, the Fed, the central banks, they can lower it down and they can have a hold on inflation. Moving ahead, the major issue we are fighting right now is inflation, but how did inflation 2022 came into picture in the first place? So we'll understand all the reasons that are possible right now. Now, the first reason is stimulus to bring back the economic recovery. So after the economic turndown, after the COVID-19 crash, we saw the prices and the economy, it started to rise up again exponentially. The fairly simple reason for that was stimulus. Now, what is stimulus? When the government, it lowers down the taxes and interest rates, it increases or it gives people a lot more ease to take money on debt and then spend that money into the market. Now, if people have money, they're spending more. It is obviously going to generate demand in the market for the goods and services. Now, if the demand is more, the companies will make more profits. And if the demand is increasing, the companies are for sure going to increase the prices because it's direct correlation. If the demand is increasing, the prices are bound to go up. And this is the concept of quantitative easing. Now, the second reason is the Russia-Ukraine war and the supply chain disruption. Now, we already know that Russia is the second largest oil exporting country in this world. Now, European Union, it decided to ban 90% of the oil imports from Russia by the end of the year. And it was done simply because of the fact that they want to take revenge from Russia. If they're not importing oil from their country, it is highly going to affect the Russian economy. Now, there's another term which is associated to it, which is PPI, which is Producer Price Index, which is a measure of wholesale inflation. Now, PPI will be affected because of the supply chain disruption as fewer items are available. Obviously, if you are not importing crude oil from Russia, there will be a shortage and people will be willing to pay more for it. And if they are willing to pay more for it, it will be a demand pull inflation. So again, inflation is increasing. The third reason is the excessive printing from central banks. Obviously, if there are more notes in the market, it will definitely going to increase the supply and the value of money will go down. And people will be again spending more money. It will be increasing the demand. And if the demand is increasing, the cost of goods is going to increase. So this is the third reason why the inflation is increasing. Now, something that you should know about Fed is that it tries to keep a positive inflation rate of 2%. That means the price of goods and services in the country would increase by 2% every single year. But for 2022 so far, we have seen 8.6%, which is huge. And it is the biggest jump in the CPI number since 1981. Now, you should always understand the term CPI because CPI is the consumer price index and is the average price of all the daily use items like food, clothing, housing. And in the graph itself, you can see from May 2017 to December 2020, we had a very consistent inflation rate, which was somewhere around 2%. But slowly and steadily, as we are moving towards 2022, the CPI numbers or the inflation numbers, it is increasing. And at this point in time, March 2022, we have the CPI numbers at 8.6%, which is huge. Now, moving ahead, what is the solution from Fed? Now, we know that the Fed has the power to play around with the interest rates in order to curb inflation. Now, that is why we have positive inflation as we discussed, so that at the point of exigency, the Fed, it can play around with the interest rate, it can lower it down, it can increase it, and then it can try to solve the problem. So in this graph, you can particularly see what has happened. So in November 2021, we saw there was a tapering announcement by Fed. Now, around Feb, we saw Fed plans to dwindle its balance sheet. Between March and April, we saw 0.25% rate hikes. Again, at this point in time, recently on 16th June, we saw there was a 0.75% interest rate hikes. So all these things are affecting the market. Now, this is called as quantitative tightening when we are increasing the interest rates every quarter, every month. Now, as a protective measure, Fed has started to increase the interest rates, hiking its benchmark rate to 75 to 100 basis points, which means 0.75% to 1% in early May, and plans to keep the hike throughout the year. Now, understand what the Fed is trying to do. It is increasing the interest rates every single quarter, every single month. Now, fairly simple reason for that is if the interest rates are increasing, people will not take debt because they will have to pay higher interest rates. If they do not have the money, the spending power will go down. That means they will not spend a lot of money in the market. If the spending is low, the demand will go down. If the demand is going down, the prices of goods and services will go down, and it will in turn reduce inflation. So that's the simple thing that the Fed is trying to do. Now, this is also one of the reasons why the markets have started to go down, because as we discussed, higher interest rates, people are not taking debts and they do not have the money to spend. So what they're doing is, for their general basic requirements, they are taking out money, they are liquidating the cash from the riskier volatile assets like stocks and cryptos. Unfortunately, we are heading to a economic slowdown because of this, from recession to depression, and this is something which we can see in coming time. Now, why are the equity and the crypto markets falling? Very simple reason. Retailers are taking out their money from the riskier assets. Big VCs and investors have exited the market. Over collateralized leverage positions are on the verge of liquidation. Celsius Network, 3AC, MicroStrategy, you know the names. Now, how to save yourself from this? Do not worry, let the market repeat and do what it does. Nobody can stop Bitcoin again to make a new all-time high after the 2024 halving cycle. And if you do not know how the market cycle works, you can definitely go and check out this last video that we posted. So thank you so much guys for joining in this session. And if you feel that this video was really helpful for you to understand about macroeconomics, how the Fed is controlling the market, and what is inflation, what are interest rate hikes, please make sure that you give us a thumbs up and follow this channel for all the important updates and concepts like these. So thank you so much guys. I'll see you in the next video. Take care. Bye bye.